Good morning from London. The opening trade brings you a special post-UK budget programme. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. Here's what you need to know. Rachel Reeves delivers a tax-raising budget and more fiscal headroom. But the UK Chancellor tells us she can't rule out future tax hikes. We'll bring you our interview. UK assets rally after yesterday's announcement. The pound firms and long-dated bonds rise, signalling a possible gilt recovery. Plus, it's Thanksgiving and volumes are low, but global stocks close in on erasing November's losses. JP Morgan economists fall into line with the December Fed rate cut call.
In the meantime, a quick check on these markets here. You're looking at Eurostoxx 50 futures that are down marginally. Remember, very low volume, I should say. You are seeing a similar story for the FTSE 100. What gets interesting is in the currency picture as well. 132 on cable, 115 on euro dollar. The countdown to the opening trade starts right now.
No Chancellor can write a future budget. I took the fair and necessary choices today, but my focus has been and always will be on growing our economy so that we can keep taxes down and have the money we need to invest in our public services.
Rachel Reeves delivering her Klarna budget. By now, pay later. It was a budget, it seems, designed to keep people quiet rather than make them cheer. The bond market, as Anna says, appears to have been satisfied, but at the cost of the highest tax take in modern history. So as America wakes up to its holiday this morning, I'm not entirely sure that the British economy, British business, have much to be thankful for this morning.
Yeah, let's talk about the budget headlines, shall we? We're going to talk about the market movements and judge it from a market perspective in just a moment. But in terms of some of the headlines we got, they had two audiences yesterday, and we talked about this in the programme. One was the bond market. Things went pretty stably there. The other was backbench MPs within the Labour Party, and the welfare reform certainly will go down well with that constituency. So in terms of appealing to those two constituencies, then maybe that's a positive, creating more headroom, but such a lot of fiscal drag. I mean, we heard from Rachel Reeves there talking about not binding, not writing future budgets. But these forecasts and this fiscal drag goes out 5 years or so, which takes us well into another parliament. They will focus on what they're trying to do around the cost of living, trying to bring down inflation, which will have an impact for the Bank of England if they can do it. But some of that's just mechanical.
It is just mechanical. You deliver higher wages to the public sector. You deliver higher wages to the bottom quartiles of the economy. You are going to see inflation, and the Bank of England is going to struggle with that. This was also a budget that was buy now, pay later. She is spending now. She's going to deliver the tax take further on. The pain is not going to be felt for a while. Maybe she's satisfied those constituencies for now. Yeah,
she might push back on the idea that if you put money into the hands of the worst off, that creates inflation, given propensity to spend. But that'll be an ongoing conversation, won't it? Because you're right. When we've seen minimum wages go up, that has been part of the argument around inflation in the past.
Yeah, it's fascinating as well because she was promising that this would be not only something that to plug up the fiscal finances, but also one that would encourage growth. I don't think we saw the growth piece in
Where's the growth? Where is the growth in this budget? There is no growth.
The entire kind of taxation scheme, at least from the income perspective, assumes that there will be wage growth. Without actual economic growth, there is no wage growth.
And we're going to hear from business, we're going to hear from the city, we're going to hear from lots of different groups, tax experts, all kinds of people through the programme. And one of the things that is, even those who praise parts of what happened yesterday, they say there is no plan for growth, there's no growth agenda, there's no inspirational message around growth. We might get some pushback on that from the Labour side, but interesting to ask our guests about that.
This felt like a budget that was designed to keep Keir Starmer and Rachel Reeves in their jobs for now, to keep the backbench MPs satisfied, to keep the bond market off their back for now. But we still have the highest rates in the G7 here, so let's not kind of delude ourselves into thinking that the bond market is behaving here. The bond market is still going to exact a price from the UK, and it's going to be a high one.
But here's a low bar. It wasn't a Liz Truss scenario. It wasn't a quasi-quarter fiscal event. It was something a little bit different, and the bond market was calmer. So it's only day one. We'll have to see what happens today.
Precisely.
There's so much detail, so much tinkering with tax policy that it'll take a while for people to work it out. But I suppose day one, they get a tick from the bond market, do they?
Well, OK, the bond market didn't. This was heavily flagged by the OBR. And as a result of which the bond market, I think, probably had largely most of the pieces in place to understand what was going to happen here. So this budget was priced. So I think from that story, I think it's hard to see how we were going to get a massive reaction. But I think if you look at the growth trajectory and you think about what is going to happen next and you think about what the Bank of England can do next, options are very limited. And it's not as if she's denying the fact that taxes are going to go up in the future as well. So yes, the pound behaved yesterday. The bond market behaved yesterday. Is that a tick in the box? Yeah, I think largely this was a budget designed for the bond market to keep it satisfied. But I'm not sure that actually long term the UK has anything to cheer about this morning. And I'm not sure the bond market in 2 weeks, 3 weeks, a month, 6 months is going to be looking at the UK that much more favourably. And
there's a whole entire issuance question that we'll talk to throughout the program in terms of our guests, in terms of just the buy now, pay later, to your point, or even the borrow later piece of that as well.
Exactly.
Let's talk about sterling for a moment. 132 this morning on cable. So all the shorts going into it that were piling in to the currency, starting to maybe see a little of them come off. That risk event is in the
is that all that pushed it up yesterday?
How are we feeling about the dollar?
Well, I think that might be just the next kind of mover in terms of how we go into the back half of the year. And we'll talk about the States in just a second. But this is really crucial because we have to now talk about pricing from the BOE as well. And that's going to be a topic that we hit across the board.
Yeah, absolutely. And there is this mechanical effect on inflation by some of the things they're doing around electricity plus. Just a reminder of how controlled inflation is in the UK, at least in some areas, train fares, exactly. So there is that. And so I have seen some people talking about more rate cuts coming through from the Bank of England, but we'll have lots of conversations about that. Morgan Stanley's closing their bullish pound, saying that we're going to get quickly to some deep cuts from the Bank of England around this. So we'll see whether that comes to pass.
Are those based on the fact that inflation is coming down? Now, inflation, you could argue, is a derivative here, or just because of the fact there is no growth, and the UK economy is going sideways to slightly backwards in terms of its growth trajectory. Is that an environment in which the Bank of England needs to be cutting rates?
Yeah.
Can it? But would it go further than it should be? Could it go further if it didn't have this inflation story still to worry about?
And I think when we talk about it from a stock market perspective as well, I thought this was interesting. I'm learning this as we go piece by piece through the 88 tax measures that were put on, is how much of this is actually attempting, or maybe an early stage, to get people to invest in the UK market specifically. Are you taking preliminary steps to get closer? And that's going to be a policy story we talk about throughout the program as well.
Yeah, we'll get some more information on that.
Yep.
Outside the UK, other things are happening, Kriti. Should we go to some of those? Fed expectations. Happy Thanksgiving, by the way.
I was about to say, nothing is happening today outside of the UK budget post-mortem, because it's Turkey Day, and we didn't bring a turkey on this beautiful set this morning, which I'll do next year. It's important, though, how we go into the back half of the year. Really low volume this year. I don't think anyone's going to show up to work tomorrow, maybe besides the poor soul that has to work that Friday in between the holiday and the weekend. But I think it's crucial here that we are now going into next week. We have 4 weeks left into the year. We'll take out New Year's. We'll take out Christmas as well. So you've got basically 2 working weeks where you have to wrap up your positions. You have to basically kind of work around the Fed and predict whether a cut coming in December actually means a cut is also coming in January and in the spring of 2026. And that's where traders seem to be very divided. So in the face of not knowing what's happening, you just take the cash off the table.
We seem a bit more convinced about a December cut, do we? I mean, JP Morgan falling into line on that one, saying that they're going to go for that they're expecting that cut in December, and the beige book certainly not giving anybody any reasons to be more doubtful of a December cut. Yeah,
what kind of a cut is it, though? Is it a hawkish cut? How divided is the committee going to be?
Sometimes the cut is just a cut. No, I'm kidding.
No, this ain't going to be one of those kinds of cuts. Absolutely not. We haven't talked about the fact that we're outside.
We have not.
No.
Let's go there.
We are outside. I think it's because, basically, I think, like the Chancellor, we like a little bit of extra headroom.
We've got so much headroom that the rain might just get in. There is a nice view behind us. You'll have to take our word for it right now, because it's a little too dark to see it. But at some point, we will get to see St Paul's.
It will be lit up very, very shortly.
You can see it now.
I'm told that we can see it in the background. It will get more visible, though, as we work our way throughout the programme. I'm not sure how much visibility we have on the British economy right now, but we're going to debate that with the guests that we have coming up. In the first hour, Jonathan Portes is going to be joining us, King's College London Professor of Economics and Public Policy. Amanda Tickel, Deloitte, lead global tax and trade policy expert, joining us. Laurence Mutkin is going to be joining us from BMO Capital Markets. He's the head of EMEA rate strategy and is going to be joining us to talk about what we see in the bond market. The second hour, Anna, we've got some great guests lined up as well.
Yeah, we absolutely do. That's bond markets, tax policy, the UK economy sewn up. Let's talk about stocks. Peter Oppenheimer will be with us, Chief Global Equity Strategist at Goldman Sachs. So we can go wider than the UK in that conversation, but of course, there were some quite interesting moves in some UK sectors yesterday, which we could dive into. Mel Stride will be with us, UK Shadow Chancellor of the Exchequer, very outspoken against the OBR, not just against the Labour government yesterday. So we'll get his up-to-date views on on that. Martin Gilbert, chairman of Revolut, will be with us, and also of River Global Investment Management. He'll be talking to us about the city, give us that city perspective on what we saw for the investment community. And John Caudwell will be with us, Phones for You founder, British entrepreneur. Does he see a growth agenda?
There's a markets question, there's a policy question. We're going to dive into it with a great amount of guests. There are some tradable events that are put on your daybook this morning. Euro area consumer confidence data comes out the minute the show is over. We can talk about Europe again. And that data coming out at 9 a.m. UK time, 12:30 p.m. UK. We have the monetary policy account as well. That's going to be something crucial to watch. And of course, we're going to get maybe the first kind of insight coming out of the BOE. Megan Green is going to be speaking at 4 p.m. UK time, but I'm convinced that everyone in the UK really is just trying to get to their Turkey Day. U.S. Thanksgiving, of course. Markets closed over in the States.
OK, let's talk about what else you need to know this Thursday morning. First up, I want to take you to Hong Kong. At least 44 people have been killed, and we've seen, obviously, a significant number of injuries. We think there probably are still hundreds missing. It is the worst residential fire we have seen in Hong Kong in a very long time. The blaze began Wednesday afternoon on a section of bamboo scaffolding encasing the structure. It then spread from building to building via wooden poles and protective netting. Hundreds of firefighters have been working overnight to rescue trapped residents. 3 people have been arrested in connection with the fire at the high-rise complex. Turning to the United States, the Pentagon is accusing major Chinese tech companies of aiding their country's military. The US is recommending that Alibaba, Baidu, BYD and others should be added to the Pentagon's so-called 1260H list. The designation would carry no direct legal repercussions, but serves as a major warning to US investors. Alibaba says there is, quote, no basis for its inclusion on this list. And here in London, JP Morgan plans to build a new 3 million square foot tower in London that will serve as its principal UK headquarters and could contribute nearly £10 billion to the local economy over 6 years. The bank says the new site will accommodate up to 12,000 people and become its most significant presence in this region, Anna.
Nice London story to end the news belt there with. Coming up, we'll be back to the UK narrative, back to the post-budget special with our stellar guest lineup. We'll be speaking first to Jonathan Portes from King's College and formerly chief economist at the Department for Work and Pensions and also previously of the Cabinet Office, so plenty of experience in Whitehall. We'll get his perspective on the budget. If you have questions, please do get in touch. IB plus BBTV Go is the function you use on the Bloomberg terminal to get in touch with us, whether we are in studio or outside, and we are outside today here in London. This is Bloomberg.
I was always clear that I would never play fast and loose with the public finances because it's ordinary working people and businesses that pay the price when that happens. So these are the fair and necessary choices in the circumstances that I faced. But what I'm now determined to do more than ever is to grow our economy so that we have the revenue both to keep taxes down and also to fund our public services.
UK Chancellor Rachel Reeves' only broadcast interview yesterday. Bloomberg was the choice she chose and came to us to talk, I would argue, maybe directly to the markets. Try and get a sense maybe of where we go from here. Let's join our first guest, Jonathan Portes, Professor of Economics and Public Policy at King's College, joining us out in the cold this morning. Formerly, of course, obviously, of the Department for Work and Pensions. You worked at the Cabinet Office as well. You are well schooled in how the British government works. Let's talk a little bit about what the Chancellor was referencing there, and that is growth. Where's the growth?
Well, the UK has been on a path of sluggish growth for really the last 15 years, and is forecast to stay on that path for the next 4 or 5. So there's no sort of catastrophic downgrade to growth, but equally there's not much in this budget either in terms of tax reform or policies more widely that will be good for growth. And while the government has set out some, I think, very sensible plans and aspirations in relation to things like planning, infrastructure, regulatory reform, it still has to deliver those. And at the same time, it's doing things which are positively bad for growth, like reducing the number of people who come here to work or study. So in order to appease reform and the anti-immigration lobby, it's cutting back on work visas and student visas. That's bad for growth. And also it's doing a number of things, sadly, which hit my own sector, the university sector, which, like it or not, is one of the UK's the jewels in the crown of the UK economy and is a big export sector.
So growth is going to be sluggish. It also does feel as if we're going to see maybe the impacts of the taxation story coming later. We're actually going to feel it in the near term. This is a Klarna budget. It is buy now, pay later. And I'm wondering whether or not we are actually going to see that tax take delivered upon, if we are going to see this budget delivering not much growth going forward from here. How certain do you think the bond market can be that that tax take is going to be delivered later in this Parliament and into the next one?
Well, most of these tax rises can be, in their own terms, reasonably trusted to deliver, right? Freezing income tax thresholds may or may not be a good policy, but it raises the tax take. There's no world in which that doesn't deliver increased tax revenues. The salary sacrifice scheme changes, which are the second largest tax increase. Again, you know, that will take a direct cut out of my salary. That's actual real tax revenue. It may raise slightly less than they expect, depending on how firms and individuals respond, but most of the tax raises are baked in. But the bigger question is, of course, ultimately, the budget is very sensitive not just to these individual tax rises, but to things like what happens to productivity, what happens to immigration, as I said before, and there almost certainly immigration will be lower than the OBR is forecast. That will reduce the tax take and be bad for the budget. And then to international events, and of course, those are not something that's under the government's control, but they're risks which have to be taken into account.
Jonathan, good morning.
Good morning.
Thanks for being out in the cold with us. What about the inflation story? Because we were just discussing in the break how some people are arguing this is going to push down inflation. Obviously, the government is suggesting that, talking about cost of living coming down, electricity, rail fares, various controlled parts of the inflation basket being weighed on. But not everybody shares that view. So what are you expecting to see on inflation?
I don't think this makes much difference. As you say, the reduction in the administered prices has a mechanical downward impact, but of a few tenths of a percentage point. At the same time, a slight fiscal loosening in the near term. And some other things like in particular, the minimum wage rise and possibly the employment rights bill put some slight upward pressure on inflation. So overall, I think a bit of a wash and not something that will radically change the bank's view or probably the market's view on what happens next to interest rates and inflation.
The Labour Party clearly talking a lot about what they're doing on child poverty and bringing hundreds of thousands, by their assessment, by the OBR's assessment, out of poverty. Whether that's their policy decision. They've also promised to bring down the welfare bill, so they need to do that elsewhere. Are there areas that are easier for them to look at on that
First,
front?
I think everybody should welcome the end of the two-child limit. It was a spiteful, nasty policy that pushed hundreds of thousands of children into poverty, and by that I mean families that could not afford food or heating. And I know that doesn't apply to many people who watch Bloomberg, but really it was a disgrace, and I personally am happy to pay more tax, and I will be paying more tax as a result of this budget to finance that. So I really welcome that. But you're quite right. The government does need to get the bill on benefits and welfare more broadly under control. That's mostly a story, first of all, about pensions, and second of all, about disability and incapacity benefits. On pensions, there is a pensions commission, but the government actually needs to start coming out now and saying the pensions commission needs to find ways of controlling the share of spending overall that goes to elderly people, especially middle and income elderly people, needs to tell the Pensions Commission has to find ways of doing that and start selling that to the public and to other parties, actually. Because remember, we had a Pensions Commission when I was at DWP under Adair Turner. It was hugely successful. We need to do that again.
I mean, I might have thought that the triple lock would go, but then given what happened with winter fuel and the way that the party tried to push that through and then had to backtrack, maybe politically or less convinced.
I mean, I think no one party can end the triple lock on its own. The Pensions Commission worked in the mid-2000s because it wasn't a Labour Party thing alone. It ended up being a strong cross-party consensus that we needed to sort out the UK pension system. The government needs to kick off that process now. It needs to start that process, but ultimately it's got to be something that's shared by all the parties and indeed by all of us.
Jonathan, I want to ask you a little bit about the business environment here. Off the back of the budget from Rachel Reeves yesterday, we actually got news this morning that JP Morgan is announcing a brand new fancy headquarters in Canary Wharf. But I thought the statement was really interesting. It got the stamp of approval from Rachel Reeves, from Sadiq Khan as well. I just want to read it to you. He says, plans are subject to a continuing positive business environment in the UK and the firm receiving the necessary approvals and agreements. Is this a positive business environment?
I mean, I think that the truth is it's mixed, and it depends who you are and where you are. It's clearly, JP Morgan clearly see it as a positive business environment, and I think they're probably right to do so. On the other hand, JP Morgan doesn't employ too many people who are close to the minimum wage, for example. And probably the employment rights of most people at JP Morgan are already well above the threshold that is set by the legal minimum. But the government is raising the minimum wage, especially for younger people, and it is introducing new employment rights for people who at the moment don't have them. And while that general direction of travel, I think there's a lot to be said for it, I think there is a risk of going too far too fast and increasing employment costs and regulation too much for firms that employ especially younger, lower paid workers, inexperienced workers, and we really don't want to stop people getting their first foothold in the labor market, and I do worry about that.
Well, Jonathan, let's talk then about how, and there's been this big conversation in the UK, but globally as well, about how everyday consumers can get more access to the public financing markets. This is something that's growing very much in the United States. It's trying to be mirrored here in the UK as well. Does this budget get us closer to encouraging everyday Brits to invest in the UK financial markets?
It gets us a little bit closer. I think the restrictions on how much you can put into a cash ISA probably help that a bit. Of course, the financial services industry needs to step up its own game and actually get out there and sell to individual middle income, upper middle income Brits that actually you shouldn't put all your extra money in cash every year. It's both it's not just in the interest of the economy, but in your own interest to have at least a portion of your savings in equities, and in particular in UK equities, which of course have been somewhat undervalued in recent years, rather than just in cash.
Jonathan, do you think it should be back? Do you think it should be back for more money? Do you think the tax take is high enough? Do you think it's going to go higher?
I think the tax take probably is high enough. I think, the truth is that, as the OBR effectively said yesterday, it's 50-50, right? Things could go better than she expects. Things could go worse. There are a lot of risks out there.
And if that's the case, that she comes back for more, is there anything that you can see in the near term that is going to avoid that possibility? What are the chances of actually seeing a cut in the welfare system? You laid out some of the things that you think should happen in terms of pensions. I'm listening to you, I didn't sound particularly convinced that you think those things are going to happen.
I think any meaningful changes to pensions will not kick in until after the next election. Right. Be realistic. On disability and incapacity benefits, I think the government actually will have to make some changes here. That will require some upfront investment, but there is, I think, a reasonable prospect of meaningful savings before the next election. I think they have to do it, and hence they're going to have to find the political will to do that.
Yeah. All right, Jonathan Portes, Professor of Economics and Public Policy over at King's College London, joining the program this morning. We thank you so much. A wide range of topics there from the professor. We talked about tax with him. We'll continue that conversation with Amanda Tickel next. From Deloitte, joining us to discuss the £26 billion of tax increases announced in the budget, 88 different measures. We'll dive into the details next. This is Bloomberg.
Thursday morning, good morning. 30 minutes to the start of trading here in Europe. Remember, America is out today. It is, of course, Thanksgiving over in the United States. Today, our focus, therefore, is what we got yesterday from the Chancellor of the Exchequer, Rachel Reeves, announcing a budget which significantly raised taxes but kept the bond market reasonably happy. After her statement, the Chancellor sat down with Bloomberg's Lizzie Burden, talking about how the revenue-raising exercise that she has delivered will actually help support economic growth.
Last year I had to close the black hole in the public finances left by the Conservatives, and in the budget last year I lived within the forecast set by the OBR. They have now changed their forecasts around productivity, and they are very clear that's nothing to do with the policy of this government, but that does mean they forecast lower tax revenue coming in. And I was always clear that I would never play fast and loose with the public finances, because it's ordinary working people and businesses that pay the price when that happens. So these are the fair and necessary choices in the circumstances that I faced. But what I'm now determined to do more than ever is to grow our economy so that we have the revenue both to keep taxes down and also to fund our public services. And that is what this government's plan for growth is all about, whether it's pensions reform, planning reform, the changes today to help make Britain the best place to start up, to scale up and to stay, with the changes to stamp duty for shares for companies newly listing in the UK. I'm determined that we get the growth that our economy has been sorely lacking for too long, and we do that through the reforms that we've set out.
Well, no confirmation of no new tax rises,
well,
Chancellor.
No Chancellor can write future budgets. I took the fair and necessary choices today, but my focus has been and always will be on growing our economy so that we can keep taxes down and have the money we need to invest in our public services.
That was, of course, the UK Chancellor Rachel Reeves speaking with Bloomberg's Lizzie Burden in her only broadcast interview yesterday after the autumn budget. It was a very busy day on the UK agenda, plenty of tax announcements. So let's have a conversation about those, shall we? Amanda Tickel joins us, Global Tax and Trade Policy Leader at Deloitte UK. Amanda, really nice to have you with us this morning. Thank you for joining us. The sun's almost up. Hopefully we won't feel too cold for too long. Let's ask about complexity and what we have now seen introduced into the UK tax system. There was a fear that maybe with lots of little tweaks that we make the tax system more complex, rather than just going for one big tax lever. We kind of saw a lot of fiscal drag yesterday and then quite a lot of tweaks. How much more complex is the UK system now, do you think?
Well, I would certainly say the government didn't take the chance to simplify or significantly reform the tax system. I think there are definitely more complexities added in here. We saw an additional category of income tax now applicable to dividends, rental income and savings income, so that's another 2% layer. And we also saw some capping of this salary sacrifice schemes for national insurance, so that will introduce new complexity. And something quite pioneering actually for the UK, looking at road pricing for electric vehicles. So a lot of new things were announced. I won't go through the 88 measures. I don't know how much time we've got, but you know, there were definitely new things.
Let's start with some of that detail then. You mentioned pioneering. I noticed in your notes ahead of the conversation you said pioneering, which also means, you know, new and not tested anywhere else. Any sense of how on earth that's going to be organised?
Well, they're going to consult, they're going to have to put a lot of design thought into this. But the challenge for the government is that at the moment, road fuel duty alone raises about 25 billion. So as we are shifting to EVs in this country, obviously that revenue is going to decline. So I was actually quite, I thought it was a good sign that they're looking forward in terms of how to make the tax system sustainable. But you're right to ask, this isn't until 2029, 28, 29, in terms of when it comes in and how it will work. Other countries are looking at this, but nobody has a really fully functioning road pricing mechanism for EVs. We have tolls, we have sort of heavy vehicles taxing in New Zealand and others, but it will be new. It will probably work alongside maybe the MOT system, something like that.
I mean, taxes are usually just by definition associated with, or the connotation is kind of a negative association, almost prohibitive in some way to that activity. I thought it was interesting that she put it on EVs specifically, even though it is a new innovation in terms of the tax system. Isn't it kind of punitive to an agenda, a climate change, a sustainability agenda that Keir Starmer has talked about several times?
That is a good point, because in the OBR report they specifically factor in that there will probably be less take-up of EVs than they originally forecast. So what the government has done, some of those other measures include extending grants for EVs, so you can get up to £3,750 for some models at manufacturer level, They have raised the level at which you have to pay vehicle excise duty on a luxury car. They've kept the benefits in kind, so it's actually really cheap from a company car tax perspective to have an EV. It's a really popular choice. Yeah. So they've kept these in place and increased those measures to try and continue to encourage the take-up. And I would say on the punitive point, I think that what they're trying to pursue is fairness. So it would still be more expensive in tax terms to drive a traditional petrol or diesel car. It would be about half the price to drive an EV.
I want to ask you about stamp duty, and specifically as it pertains to the stock market. We were just talking to Jonathan Portes about what kind of pieces in this budget incentivize actual investment in things like the FTSE 100. Does this budget signal to you that we're getting any closer to a change on the view when it comes to stamp duty applied to that?
Yes, I mean, they have announced that there will be immediately a reduction in the stamp duty. So there isn't any stamp duty at the moment on newly listed shares. But what they're saying is for the first 3 years of those shares' life, there won't be any stamp duty. That's at 0.5%. So it will represent a significant saving. But what we haven't quite worked out yet, I was thinking about this last night, is what will happen the day before the end of 3 years? Like, would that trigger some sort of selling? But I don't know. They're really trying to encourage that listing and growth and investment in the UK. You could see this story coming through as well with improved terms for investment management incentives and venture capital trusts. They're trying to expand the number of employees and assets and the amount that you can invest in those. So giving some sort of growth story.
Is that enough incentive, do you think? If we're looking for growth, if we're looking for investment, not just from the financial community, but from everyday savers and earners, does this go far enough? Does this forge enough of a path ahead?
Yeah, I mean, it's a good point. I think the government has struggled somewhat with the narrative around growth. So what they've chosen to do is take a path of talking about stability. You know, we're going to keep corporation tax capped at 25%. We're going to keep the 100% capital allowances. You know, we're going to give certainty in the UK system. And so that's the path they've chosen, rather than necessarily a big fanfare about attracting investment. Perhaps they could do more on that narrative.
Amanda, if I run a British business this morning, am I incentivised or disincentivized to invest in my business or employ people?
I think the biggest message that we're getting immediately is we're glad that we now know what was in the budget, because it was such a long run-up, 12 weeks, a lot of kites were flown.
So do we have certainty now?
I think we do have certainty now. You know, who knows what's going to happen next year, but for the moment we do have certainty. We know when those tax rises are going to come in the future. So I think businesses will be hoping that consumers get back out and do their Christmas shopping and actually feel more certain now. There are some increased costs for business. The minimum living wage went up, of course, and there are some changes around tax release for things like pensions and the salary sacrifice. So all employers will be looking at these changes across the board and seeing what they mean for them.
Can I ask you about, some people call it a wealth tax, other people call it a high-value council tax surcharge. Yeah. Is this going to create weird behaviour around these specific points? Because it's got very, very distinct brackets, 2 million, 2.5, 3.5, 5. Is that going to distort the housing market?
I mean, it might do. This is a really interesting development. Of course, it only affects a very small number, under 1% of properties in the UK, and therefore sort of the wealthier end of the market. But it's the first foray into taxing wealth. It taxes an asset that you're just sitting in or on, you know, regardless of whether you've got a mortgage against it, regardless of your income levels. So I think it was interesting they went for a wealth tax of sorts. And you're probably right, around that first threshold of 2 million, when you start paying the first surcharge, I can imagine it might create some sort of a buffer or disincentive to go above 2 million.
Amanda, great to see you. Thanks for stopping by.
Thank you.
Outside.
Lovely.
This Thursday morning. We really appreciate all our guests joining us outside. Amanda Tickel, Global Tax and Trade Policy Leader, joining us from Deloitte UK. Now remember, the United States is closed today. They are giving thanks over in the United States, as a result of which you are going to see super light volumes. You've already seen it over in Asia, and you are now likely to see it here in Europe this morning. So I'm not sure that the futures give us a particularly good guide this morning. And to be honest, they're not really moving very much anyway.
Yeah, they're not moving much anyway. I think one of our team was saying 30% lighter on volumes through the Asia session, so maybe that's what we have to look forward to. And no cash trading, of course, in treasuries and in stocks. We have futures open, and in fact, Brent crude closes early, doesn't it?
It's all about turkey today. That is the message.
Where's breakfast,
I
Chrissy?
mean,
keep mentioning the food.
Yes.
I know. I am hungry.
Is it too early for
I'm also
pumpkin pie?
Never.
Never.
It's never too early for pumpkin pie, hot chocolate, all the jazz. I'm getting a turkey on set soon. In the meantime, a quick check on these bonds, which are going nowhere in a hurry. I was getting excited that there would be something juicy there. But again, to your point, not getting much of a lead from the Treasury picture. That being said, I think we can kind of discount today in terms of some of the bond market action. Monday gets interesting when everyone comes back to their desks.
There was a decent move yesterday in the gilt market, particularly at the long end. So the long ends did react reasonably well. Front end less so maybe than what we saw at the back end. But there was quite a decent market reaction yesterday in the bond market. I'm not sure Sterling has firmed a little bit. Maybe some of the shorts came out. Maybe there's a market positioning story. But there was a decent move at the back end of the gilt market.
Yeah, and it does tie into this question about how long does it take to get a verdict on a budget. I mean, it's all very well if things happen in the moment.
I think we've got one this morning.
Do we have one? Well, we haven't yet, have we? I mean, I can't see a clock, but we've got minutes only. How many minutes? 19 minutes until the start of gilt trading. So, we'll wait and see what happens this morning. But to your point, maybe Monday, maybe when everybody's back.
I mean, the speed at which the narrative changed around whether or not this is actually a good or a bad budget in the bond market, especially with the OBR leak and then the kind of buy now, pay later, to your point. For a second, everyone was really relieved. Everyone was like, oh, this is great.
Headroom.
So much headroom. Yeah. Just kidding. In the meantime, let's get a little bit more analysis here and bring in our Bloomberg UK Wealth editor-at-large, Marin Somerset-Webb, who, of course, will be digging deep into the budget story on her Marin Talks Money podcast later this morning. She joins us now. Marin, just your initial take on these 88 measures.
88 measures, I know. Well, first take, too many measures, too complicated, too difficult. We would have been much better off if the idea was to put up taxes, which of course it is, rather than to reduce spending. We would be much better off going back to just putting up income tax across the board, done in a oneer. I think it would have been much simpler, much more straightforward.
Yeah, I mean, there's lots of people talking about that added complexity and maybe just pull one lever rather than many. I guess the Labour Party, if they were here, they'd point towards things they're doing around cost of living, around electricity, train fares, that mechanical stuff on inflation, and also bringing children out of poverty. That's what this budget was for. It had that audience and stability in the gilt markets, I suppose.
Yeah, and it achieved both those things. The gilt market is not upset, everything's fine, feels a little stable. But what it doesn't do is even begin to solve any of our major problems. We look at the UK, what's our real problem? It's lack of growth, it's lousy productivity, it's a very high welfare bill relative to the income tax take, etc. It's all these long-term things. And this is not a budget that fixes any of those things. It was, which I think has been said many times over since yesterday, this was a budget about saving Rachel Reeves' job more than it was a budget about improving the long-term outlook for the country.
How do you think the housing market's feeling this morning?
Well, do you know, one of the things we're going to talk about, we're doing a recording of a podcast shortly, and I'm sure that the thing...
Here.
Yeah, live here, very exciting,
Excellent.
Big audience, great building, coffee, croissants, marvellous. But one of the things that I know
Are you inside?
We are inside.
That's very unfair.
Yeah, I know, I'm really sorry about this, but I couldn't fit my 500 people out here. You're doing, guests one by
Will
one.
there be
I've
a turkey?
got hordes of them. But one of the things they're going to ask about over and over and over is going to be about the mansion tax, and it's going to be about wealth taxes in general. Where are we going with this now? We've started down this road. But, there is a reason why government after government after government has talked about a mansion tax and not come through with it. Because it's incredibly complicated, it's difficult to implement. Who says a house is worth £2 million or £2.5 million? Only the market can tell you that. You can't guess it. You can only know by putting a house on the market and seeing what someone's going to pay for it. You can't do that with hundreds and hundreds and hundreds of houses. So what we're now going to see, if this happens, which it very well may not because of these reasons, you're going to end up with it's going to be tied up in court forever while people argue about their valuation non-stop. And of course, the existence of the tax itself changes the valuation of your house. If the market would pay just over £2 million for it yesterday, certainly not going to today.
Yes.
So, there's a reason this hasn't happened before, and there's a reason there hasn't been a council tax revaluation before, because we're very happy leaving those bounds relative as opposed to absolute, right?
Okay.
Revaluing that is impossible.
Marin, thank you very much. Yeah, we'll see how granular those valuation conversations get and whether it comes to pass at all. Thank you very much, Bloomberg UK Wealth's editor-at-large, Marin Somerset-Webb. And as she's been saying, you can catch her in the next hour hosting a live taping of the Marin Talks Money podcast. You can watch it live via the terminal on Live Go or on the web at Bloomberg.com or listen back later on Apple, Spotify, or wherever you get your podcast. Maybe from a selfish perspective, we'd say listen back later, but you know, we'll leave you to make that choice. You can listen to either in the next hour. Coming up on this program, long-dated gilts jumped on the budget announcement yesterday. We will discuss rates moving forward with BMO Capital Markets. Laurence Mutkin, he'll be with us on set. This is Bloomberg.
Thursday morning, happy Thanksgiving. Let's talk about the gilt markets and what we saw yesterday. We're about to have the gilts reopening in a few minutes' time. Before we get to that, though, it's worth maybe reflecting on what the two-day session looks like. As you can see, particularly at the back end, long tenor doing well. We saw a decent bid coming in yesterday. Yields came down. The bond market had a fairly good day. Sterling, I'm a little less convinced about the sterling move and what we are seeing. A few shorts maybe being taken out. But I think what Rachel Reeves managed to achieve yesterday was that she didn't particularly upset either the sterling market or the bond market, and maybe that is a big tick in the box. Laurence Mutkin can answer as to whether or not that is true. EMEA rate strategy and head of BMO Capital Markets. Good morning.
Good morning.
Nice to see you.
Nice to see you.
Did she tick the box yesterday? Are you happy this morning? Is the bond market, the gilt market, feeling satisfied?
I think it is happy enough. As you say, the market did well yesterday. And I think that's because there were basically, three channels she had to get right for us. One of them was about issuance, one of them was about fiscal credibility, and one of them was about the sort of trajectory for inflation. And especially the issuance one, was pretty good news, and especially at the long end. And the debt management office is able to cancel a couple of long auctions and change some syndication. So there's very little issuance at the long end now, between now and the end of the fiscal year, which is March. So
how fragile is that confidence?
The confidence in supply is not fragile for this year, nor for next year. And I think issuance is a big thing for the gilt market. I think the path of policy rates is the next big thing. I think the confidence thing people talk about fiscal credibility, I've always thought was a little bit overstated as a worry. The truth of it is, yes, there are fiscal rules, yes, there's headroom, it's back and so on. But, really, the UK, its debt to GDP is kind of middle of the pack, which is high, but everybody's high since COVID. The deficit's not huge and it's coming down. That's not an issue for me.
Laurence, good morning. So sticking with that theme, I'm just looking across EMEA bond markets and the yields, 4.4% on the UK 10-year. Everything else everything in Europe, Eurozone, seems to be, and elsewhere in fact, is a lot less. So where does that premium come from if it's not about fiscal credibility? Is it just the ECB is the backstop and they all benefit from Germany? Is that why in the UK we have to pay more?
I think it's exactly the right question. I think there are two elements of it. One is a sort of long-term credibility question, but I think the main thing is inflation. Because really, bond investors, these are government bonds. You just want your money back, right? But you want the money in pounds that are worth something close to what you paid for them. And I think the problem that the UK has had is it does have sort of European levels of growth, but it has kind of US levels of inflation, right? And it's the inflation premium that keeps yields high, I think, more than anything else in the UK.
I want to come back to the issuance point that you made.
Yeah.
Given so much of this budget is backloaded in terms of some of the revenues that actually hit the coffers, not to mention bleed into the next election cycle as well, do you think the issuance line changes in 2 years' time?
2 years is an interesting time to mention, actually, because one of the things that happens in 2 years is that issuance is pushed up because of rolling over debt that was issued a year ago. So actually, we do have a fall in issuance next year, but then it goes up again in a way that was not forecast in March because they borrowed an extra 40 billion. So it's not going to go away as a problem, right? We are borrowing 300 billion this year, a bit more. We're going to go to 250 odd next year, then back up somewhere between the two. This is a lot of debt for the gilt market to take down. So it remains a kind of permanent source of anxiety for the bond market, but at least we know what it is.
Yeah. Laurence, it's really interesting. In this country, conversations around the gilt market and yields have entered into the sort of popular psyche and into mainstream media conversations over the last few years. I mean, Liz Truss had something to do with that, but then that sort of lingered, and partly because of a lack of headroom. But now we have more headroom. She's doubled the headroom in this particular budget. Should that mean that the rest of the country needs to worry less about what's happening day to day with gilt yields? And sure, the OBR will say things once a year, but other than that, they shouldn't have to worry about it too much, because I think probably from the wider public, that's what they'd like. They'd like to be able to put this back to one side.
The thing that the yields that really affect the wider public are 2 to 5 year interest rates and what it does to their fixed rate mortgage rates.
Yeah.
Right? And in that sense, they're always worrying about the combination of the Bank of England and the gilt market without necessarily worrying about the gilt market. What happens to long end yields? It should be harder to locate that. But of course, it does matter to you in terms of, what is your pension going to look like in the end? What are your returns going to look like in the end?
Yeah.
So, yeah, kind of. But as you say, it's an unusual thing that anyone worries about the bond market at all in this country. And that's probably helped, right? That's probably helped reinforce fiscal discipline in governments, I think.
Yeah. And we're certainly seeing that. At least this is one of the problems, to Anna's point, the thorns in the sides of the Americans. So much of what's driving the markets is actually public perception as opposed to what the BOE and the government is doing. Laurence Mutkin, BMO Capital Markets, head of EMEA Rate Strategy. We will leave the conversation there. Thank you so much for joining us. Of course, a timely one, Anna, just ahead of the Gilts Open.
Yeah, ahead of the Gilts Open, ahead of the market. We'll see whether there's another day of reacting to the budget in the Gilts market or not, ahead of the market open in terms of stocks as well. Guy's disappeared. You'll note he's not in the shop anymore.
We kicked him out.
We kicked him out. He's disappeared downstairs. He volunteered for this mission because it takes him into the warmth. We can all understand that. But he'll be back with the market open shortly, and Kriti and I will be here as well. We will be reunited for plenty more conversations in the second hour. The market open is next. This is Bloomberg.
Thursday morning, couple of minutes to go until the start of trading, in equity markets here in Europe, but also critically the gilt market as well. We'll talk about that in just a minute. Before we do all that, let's talk a little bit about Thanksgiving Eve. Yesterday, Wednesday, budget day here in the UK, Thanksgiving Day over in the United States. A decent rally early on, but then basically we just pushed sideways throughout most of the afternoon. I think a lot of people would have been getting on planes, getting into cars, going to see family for the holidays, and I think probably we are going to see today a session of light volume, which is kind of what we saw yesterday afternoon over in the United States. Therefore, what we're seeing today in terms of the European futures picture when it comes to equities is nothing, really, to be honest. Light volume, I think, is going to characterise the session. As you can see, the Euro Stoxx 50 futures are barely budging. We are flat. I think we're probably, as Kriti said a little bit earlier on in the programme, going to have to wait until Monday until we see actually a realistic market pricing. FTSE futures absolutely flat. DAX futures absolutely flat as well. So that's the picture. It is Thanksgiving over in the United States. Volumes are going to be light, which continues, therefore, us to allow ourselves to discuss what happened yesterday here in the UK and the budget and the impact that that's going to have. And the Gilt Open, guys, is almost upon us. From the warm to the cold, I hand things back over to you.
Stop enjoying yourself too much in studio. He will be back, won't he, in the cold with us shortly. He's really bragging. But we are just moments away then from the start of equity trading here in Europe. Yesterday we saw technology stocks doing really well, the likes of ASML. So outside of the budget story, there are other things to talk about. But we're also 20 seconds away from the Gilt Open.
We are, and I think this was really fascinating because, again, we kind of had a 180 in the intraday session when we had the kind of sigh of relief from the OBR leak in terms of the number being higher. But then as we went through it, a lot of panic. Do we start to see some of that move, some of that headache get retraced in today's session? Guy, of course, has the opening trade. Guy, what do we see?
OK, let's see what we're going to get here in Europe. I'm not sure you're going to see much heat. I'm not sure you're going to see much action. I think it's going to be a fairly quiet session. The FTSE 100 is barely budging as anticipated. We are absolutely flat this Thursday morning. I think volumes are going to be... Actually, to be honest, volumes have been light all week. And I think very much today is going to be the kind of the bottom. Maybe tomorrow as well. We'll return on Monday, maybe with some better price action. But there you go. Market's doing absolutely nothing. The Stoxx 600 is barely budging. We are down by 0.03 of a percentage point on the Stoxx 600. The CAC's not really moving very much. The IBEX is not really moving very much. We'll wait for the Germans to get going in just a moment. But the overall narrative at the moment is actually that we have seen a decent rally back for equities over the last few days. Maybe an November won't be that bad for the global equity market, but we're going to have to wait, I think, for a couple more sessions to confirm that. Kriti, what else are we seeing this morning? What else are we watching this morning as the Americans enjoy their turkey?
I mean, can you blame them? I've got to say, when you look at some of the sector moves, some of the individual movers, it does seem to be a heavyweight story. And I think this one's interesting here because I'm looking at the biggest weight on the stocks on the downside. It's ASML. So you are seeing some of that tech trade kind of come out. To the upside, it's actually Rheinmetall. And I'm curious how that kind of factors, because these are two stocks that have major valuation concerns kind of hanging over them in terms of the tech and the defensive trade. From a sector perspective, red and green on the screen.
Yeah, food and beverage stocks seem to be doing pretty well this morning. So I'm looking at the GRR screen on the stock 600, and we've got food and beverage is the best performing sector. Pernod Ricard in particular doing pretty well. Consumer products and services also on the rise, but none of these are moving by all that much. You know, this sector, these sectors are up 2-3/10%. So not a day for big moves. A day for sitting on the couch, perhaps.
In honor of Turkey Day, this is the advice everyone gives you on Thanksgiving: is that you take your Thanksgiving feast, you kind of meet the family, you get your cranberry sauce, blah, 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 blah.
Yep.
You have your massive feast, your pumpkin pie, and then you go to sleep. Turkey's supposed to make you sleep. And I think in honor of that holiday, I imagine we're getting a little bit of a sleepy session
That's
today.
what the market has been is doing then,
Yes,
in
exactly.
honor of Thanksgiving.
This is the market analysis
to make you feel at home
that you need on Bloomberg Television.
Yeah, absolutely.
Guy, walk us through kind of what we're seeing in the bond market here. Is it as sleepy as it is in the equity market?
I wish I could bring you something more, Kriti. I wish I could bring you some more action, but I can't. The gilt market's action, it appears, was yesterday. The gilt market seems satisfied with the delivery of the meal yesterday from the Chancellor of the Exchequer. Ticked all the boxes, delivered what it wanted. Yes, the tax take in this country is now the highest it is on record, but the bond market kind of got what it wanted, A, on the tax side, and B, on the issuance side, as we were hearing from Laurence Mutkin just a moment ago. So actually, to be honest, the action this morning is not very significant in the gilt market. We've ticked that box. We're moving on. We're on to Thanksgiving. We're on to maybe a quieter session. So maybe as we start to get going, we'll get a little bit more action, but I'm not seeing very much of it at the moment when it comes to the 2s, the 5s and the 10s here in the UK. Now, yesterday, the picture was a little bit different. We did see some action when it came particularly to the long tenors here in the gilt market. And as you can see, a decent bid coming into the long-dated bond market yesterday, yields coming sharply lower. Now, in some ways, the UK is much less sensitive to this end of the bond market than maybe the United States is, but it was a significant move, and it did have an impact. Whether or not actually this is going to be sustained remains to be seen. Whether or not this is a reaction that is going to be sustained by other markets elsewhere remains to be seen. But at least yesterday, Rachel Reeves did get that tick in the box. We didn't get the turbulence in the bond market that some had feared, though, to be honest, the bond market pretty much had all of the pieces of the puzzle in place before she got up and started speaking yesterday, with the help, maybe, of a few of the UK institutions that provided an early look at what she had to say. Kriti, over to you.
Fascinating one. Let's get a little bit more analysis on how this shows up in the equity market. We've got a guest out here with us. Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs, joins us right here on our Make Do set today. Peter, we've got a ton of questions on these broader markets, but in honor of our UK budget special, we'll start right here with the UK. Your initial thoughts on kind of what we learned from Rachel Reeves yesterday. Does it have a read-through into this equity market?
Yeah, morning and happy Thanksgiving.
Thank you. I appreciate that.
I think it does. There were a lot of concerns going into the budget because of so many leaks and uncertainties about the fiscal headwind. And overall, I think markets have taken it rightly in quite a positive way. We are going to see a progression of lower inflation. That was going to happen anyway, and I think this adds to that. And most importantly, from the equity market's perspective, you got the read-through from the gilt market. And I think this is positive for gilts. We would expect yields to continue to progress downwards to around 4% by the end of next year. And the main way that that impacts equities in the UK is domestic equities.
Yeah.
If you look at domestic equities, if you look at the FTSE 250, it's underperformed the FTSE 100 by 11% since June of this year, so quite a lot. It's very cheap. It has a dividend yield which is 100 basis points higher than the FTSE 100, which is already very high. And I think lower interest rates tends to be positive for that part of the market and domestic stocks in particular.
Peter, I'm going to ask you a little bit of a curveball question, out of character, I know. Talk to us a little bit about, there are pieces of the budget that kind of felt like they were laying the groundwork for for incentivizing everyday earners and everyday consumers to actually invest, not just in the stock market, but specifically in the UK stock market.
Yes.
I didn't feel like that went far enough just yet, but do you feel like this lays the groundwork for more retail participation in the UK stock market?
Yes, I mean, there was clearly a hint towards that, specifically in terms of some reform to the ISA system. So this is the system in which people can put a tax-free allocation historically to a mix of equities or cash. Now, about half of all money that goes into ISAs historically has gone into cash. And that's effectively the government giving a tax break for people to put money into a risk-free asset with a very low return. So they've wanted to try and encourage people to shift more into equities by reducing the amount that they can put into cash. I think that's a positive thing. The asset managers were up yesterday on the back of that because that should, and I think will in time, create more flows into the UK market from a low base.
But that doesn't necessarily, yes, it incentivizes that from a tax perspective, but it doesn't require UK equities specifically. Is that the next step? Is that what we need to get this kind of structural push into the UK equity market?
Well, it's partly that. Of course, retail is a small part of the overall picture of who buys equities. I think the other part of it, actually, in the UK, and this is similar across Europe, is that big institutions like insurance companies and pension funds have been consistently selling equities over the last decade or so, partly to reflect changing regulation that's forced them more into bonds. UK pension funds, for example, back in the late 1990s owned about 60% of the UK equity market. Now it's about 5%. So any moves in the future along those lines would also be helpful, I think.
Peter, you mentioned that this will have an impact on domestic stocks, and we saw a bit of that yesterday, didn't we? I mean, are you assuming then that inflation comes down, gilt yields continue, will fall as a result of this? What kind of upside can that offer then for domestic stocks?
Well, I think quite a lot. As I said, look, the UK market, we should say, has done well this year. You know, it's up with dividends roughly 20%, stronger than the S&P, and there isn't a single tech stock in the FTSE 100. Now, the FTSE 250 has lagged behind, and it's largely because it is more domestic and there's less liquidity. I think that it's very interest rate sensitive as well, because you have things like house builders in there and other very interest rate sensitive parts of the market, more domestic consumer related areas. So I think with the prospects of lower interest rates and gilt yields, that should benefit. I think there's reasonable upside. I should say that we expect policy rates to be cut in December and then 3 times next year. So getting the base rate down to 3%, and that should help gilt yields moderate as well.
And that will be the dominant narrative that will drive real estate stocks, I guess, because yesterday we saw something a bit more divided. You know, some real estate stocks benefited from this assumption about lower gilt yields and lower cost of debt, but others were penalised because, of course, what's happening with the wealth tax at the sort of more luxury end. That's an extra complexity, I guess, now from a real estate perspective.
Yeah, that's true. There is that's true. There is a bit of a mix, but that particular reform in the tax system is going to target a very small part of the overall housing market. And of course, the government is also pushing ahead with planning reforms to ease regulations. So there should be more house building.
And so where does the UK equity market fit then in your sort of landscape of European equity markets? Well, what are you expecting for next year?
Positive. I mean, all equity markets, we should emphasise, are quite expensive now relative to history. That's true even for the UK, actually. Not the FTSE 250, but the FTSE 200. It has a higher valuation than its long-term average. And so I don't think valuations are really going to be the big driver of returns, although we should see a bit of an uptick in the FTSE 250 because it has that really high yield. And I think it's also worth bearing in mind that while growth has been the real dominant factor in equities in the last decade, led by technology, this year we've had quite a big mix of growth doing well, but also value stocks being re-rated. And the UK is a really dominant value market, has a high yield, very high free cash flow yield, very low multiple. The banks, for example, will benefit, I think, from these reforms as well, and no banking tax, that was a concern. They have a multiple of about 8.5. And so I think, again, that area of the market, for people looking at value, the UK is quite an attractive proposition.
And looking at global stocks, we seem to, the Fed seems to have delivered early, or the Fed narrative at least has delivered early in terms of some kind of Santa rally. We've seen stocks recovering from some of their November losses, or close to recovering globally from November losses. How much cutting do we get from the Fed, and what's the read across from that cutting into the stocks narrative globally? Because it has been driven by the outperformance of tech.
It has, but again, well, two things. Firstly, we do expect rates to come down in the US to around 3% by the middle of next year. And that, coupled with ongoing economic growth, some moderation in the dollar, is a reasonably good setup, I think, for risk assets and equities in general. You're right that tech stocks have continued to dominate the US market. They make up almost 40% of that index, and they've done well. But let's not forget, this year is a year where diversification has really worked.
Yes.
This US stock market has actually underperformed most other equity markets, including the UK. And many of these other markets, like the UK, don't have any or very little tech exposure. So you are seeing this broadening out. I think that will continue. Aggregate upside, I think, is limited because valuations are reasonably high. But we're going to get profit and dividend growth, and that should really drive equities.
Peter, thank you so much. Thank you for braving the cold with us. It was much nicer weather yesterday. Should have been yesterday, but thank you very much. Thanks for being here. Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs, giving us his thoughts on the UK market and much beyond. Let's check in on individual stock movers today. Chloe Melly is still with us. She's downstairs in the cold, and she has an update. Puma certainly on the move this morning then, Chloe.
Yeah, absolutely. Good morning, Anna. Puma is up very strongly, more than, almost 15% this morning, as it is said to be drawing a lot of M&A attention. So the Chinese company Anta Sports is reportedly considering a bid for the company, and that is just one among several other potential bidders. And that is something that investors seem to be very enthusiastic about. Puma has been struggling to get investors and consumers really enthusiastic about its products, really excited about new products. It is now undergoing a turnaround, and therefore the prospect of a potential takeover is being welcomed very warmly by the market this morning. Moving on to drinks, after all, it is a holiday somewhere, maybe not here, but somewhere, and we are seeing some positive movements across the board there. So Rémy Cointreau reported better than expected sales growth in the first half. It actually reported a fall in profit because it is facing quite a lot of a weakness in the Chinese market and currency headwinds. But the fact that the sales growth was better than feared was seen as very encouraging and very reassuring for investors, and therefore it is also driving up some of its peers. So we are seeing Pernod Ricard and Campari also up almost 2% each this morning. Moving on to Zegona, which is an investment company that is specializing in the telecom space, and it will return 1.4 billion euros to shareholders in the form of a dividend and a share buyback. This is something that investors are thinking about quite positively, and we're up more than 2% there. And finally, Entain, the gambling company, is down a little bit this morning after detailing some of the impact, the profit impact of the hike in gambling taxes that we'll have here in the UK. It said that the EBITDA impact will be about £150 million from 2027. That's not negligible, and therefore we are down about 1%. Analysts did say that most of that impact is priced in, which explains that this weakness that is not absolutely major for Entain, but we are still down a little bit.
Chloe, thank you very much. Chloe Melly from our equities team. Thanks for the update. So a host of movers from consumer products to drinks. I noticed Deutsche Börse are doing OK this morning as well. We'll have more on the UK budget, though, coming up. We'll continue those conversations from here on the balcony. St Paul's Cathedral in the background. This is Black.
Welcome back to our budget special. Let's talk about the bond market a little bit more and how we should perceive the UK this Thursday morning. The bond market largely was OK with what we learnt yesterday from the Chancellor, Rachel Reeves. Is that enough? Is that tick in the box good enough for now for the UK to keep calm and carry on? Let's try and answer that question. The UK Shadow Chancellor is Mel Stride, and he joins us now. Mel Stride, good morning. The bond market is OK with what it heard from the Chancellor yesterday. Is that a tick in the box? Is that good enough?
It's too early, 24 hours out from a budget, to really know exactly how it has landed. And of course, I think implicit within the decisions taken within this budget are a lot of challenges that lie ahead, not least layering up taxes on hard-working people, and as a consequence, spending some of that money at least on increasing benefits. I think part of the story, though, on the markets right now is that, of course, we've gone through a period of many weeks of speculation, of leaks from the Treasury about what might be in the budget and U-turns on that and so on and so forth. And I suspect there's at least some relief out there that we now know what is in it, rather than fearing all the different things that may or may not have been in it.
I'm thinking about this budget as being the Klarna budget. It's a buy now, pay later budget. And I'm wondering whether or not you think when the pain arrives, the reaction will be maybe quite so benign.
Well, I think that's a good question, because the way this has been structured is that £26 billion of increased taxation has been loaded on working people. That kicks in towards the end of the forecast period, i.e. a few years' time, whereas the actual spending part of it is front-end loaded. So a lot of the pain is going to hove into view through time rather than being felt immediately by people. And I think if you add that to the fact that, of course, these tax increases will be penciled in for when the general election is not far off, I think it is a perfectly fair question to ask whether the government will have the discipline to actually continue to pursue that path. What they should be doing is getting on top of public spending, on government spending, particularly around welfare, getting that down so that they can both bear down on the deficit and what we're borrowing, but equally get taxes down rather than seeing them go up as they are.
Mel Stride, good morning to you. Do you think, though, that the Chancellor does deserve some credit for managing to thread the needle that saw her not create any drama in the gilt market and at the same time take hundreds of thousands of children out of poverty? That is a very tough needle to thread, perhaps. Does she deserve some credit for that?
Well, no, I don't think so at all. I think she's taken all the wrong choices. If you go back to the first budget back in October of last year, she heaped taxes on businesses, which is part of the story as to why growth has been so anemic. They are borrowing vast amounts of money and spending vast amounts of money, about £500 billion over the Parliament compared to the plans that they inherited from us. That has stoked inflation, kept interest rates higher for longer than they would otherwise have been. And we've seen another kind of turn of the handle on this in the budget yesterday, another £26 billion worth of tax increases. That is the way to ending up, as the OBR has said, with the highest tax burden in the history of the United Kingdom, and a situation where that will be impeding growth. And you can see that in the OBR's figures. Growth is down, inflation is up in the forecast, unemployment will be higher every single year of the forecast compared to the last forecast back in the spring, and people will be relatively worse off. So I'm afraid the wrong choices are being taken. What she should be doing is bearing down on government spending in order to get taxes down, not taxing in order to put benefits up.
Mel, you mentioned the OBR, and that it played a slightly different role to usual yesterday with an early release, of course, of the Chancellor's statement. You were outspoken about that on that subject, saying that this could even have been a criminal act yesterday. Any further reflections on that? Any further thoughts on the future of the team at the OBR and whether this is indeed a criminal act?
Well, look, there's an investigation ongoing at the moment. It appears from what we're hearing now that the OBR, well, are saying that this was a mistake, a technical error around the timing of the release of their report. And if that is the case, it's obviously far less serious than if somebody was deliberately attempting to take advantage of early access to market information or whatever it may have been. But you're absolutely right. I mean, this is a very serious matter. It is unprecedented that this should have happened, that you have a Chancellor of the Exchequer standing up in the House of Commons whilst the entire contents of the budget has been released by the OBR about an hour before she did so. That is clearly completely unacceptable. So we do need a thorough investigation into it to understand exactly what has happened and therefore what consequences should follow.
Laurence Kriti in London, thank you for your time this morning. Can you talk just a little bit about how the business community should be viewing this budget? We know that Rachel Reeves has been looking to incentivize growth, as many of the governments have before her. Talk to us about how the business community may or may not be viewing this budget and what maybe the Conservative Party should be doing differently to incentivize further investment from the financial community.
Well, the UK business community at the moment, in terms of confidence, is flat on its back. In fact, the Institute of Directors, which has a regular survey of business sentiment, has had surveys recently that are the worst ever in the history of their surveys, and that includes COVID, when the economy here shrank by 10% overnight. Things are pretty dire. A lot of it is around business taxation, particularly the national insurance hike that the Chancellor brought in after her first budget, which really has destroyed jobs and business confidence and growth. And as I say, to the second part of your question, what we should be doing, what my party would be doing, is we've identified £47 billion worth of savings across government, 23 billion of that coming from the welfare bill. And we should be appropriating those savings both into getting the deficit down, but equally into getting taxes down. And the kind of taxes we should be looking at, or I would be urging the Chancellor to look at if she were to take those decisions on spending, are those that relate to business and getting business moving.
Thank you very much for your time. Mel Stride, UK Shadow Chancellor of the Exchequer, thank you very much for joining us. Just time for a quick word on the markets this half hour. Skylar Montgomery-Koning joins us from the Bloomberg Markets Live team. Skylar, we saw actually some UK stocks benefiting yesterday. The FTSE 250 quite liking what it heard by the end of the day, at least. In specific sectors, real estate was a bit divided, but some of the brokers, wealth managers did pretty well. How did you see it go down with stocks?
Yeah, absolutely. I think generally because the budget was pretty okay, actually, like it was quite positive, I think, for markets generally. You had premium come out across assets, including equities. Specifically within equities, there were a couple measures that were meant to be more positive for them. So for example, if you look at the ISA allowance, the allowance is still 20K, but only 12 of that can be used for cash now. So hopefully that 8,000 goes into UK equities. I think the issue is, that's quite a small measure. It doesn't actually mean that you have to go into UK assets as well. You can still go into global assets. You also got dividend tax raises, and the overriding driver of equities is growth. And this is more growth negative than anything else. And so I think while you can cheer in the short term, it certainly doesn't put you on completely positive footing. That's particularly for the FTSE 250, which is more domestically oriented. I also don't think you're in the all clear on the FTSE 100, given that that's been driven in the past year largely by pound weakness, which seems more unlikely to repeat from here. So I think it means that you need to be more defensively allocated within there, especially because I don't see the equity market globally being very strong into year end, and you also have Bank of England easing bets helping those sectors.
Skylar, great to see you. Thank you very much indeed for joining us up here on the balcony. Skylar Montgomery-Koning from our M Live team. You can, of course, follow the M Live team throughout the morning. It is a quiet day. The US is out. We're going to carry on our coverage of the budget. Martha Gilbert's going to be joining us next. This is Bloomberg.
Welcome back to the opening trade and a very special edition of it. It's the UK budget special. We're 30 minutes into today's session. It's Thanksgiving over in the States. Happy Thanksgiving for those that are celebrating. When you look at the futures picture, the equities picture, habit, green on the screen everywhere, it seems, including in the DAX, higher by 0.3%. That's your outperformer this morning. SAP, Rheinmetall seem to be the stocks that are moving to the upside, but amid very, very low volume.
Low volumes, small movement in these European equity markets. Let's get an update on some of the other stories that we're keeping across for you this morning. At least 44 people have been killed and hundreds are still missing in what is Hong Kong's worst residential fire in decades. The blaze began on Wednesday afternoon on a section of bamboo scaffolding encasing the structure, then spread from building to building via wooden poles and protective netting. Hundreds of firefighters worked overnight to rescue trapped residents. 3 people have been arrested in connection with the fire at the high-rise complex. Back in markets, in corporate news, Puma shares are rising sharply. That's as the Chinese sports apparel company Anta Sports is said to be among firms exploring a potential takeover of the German company. Sources say Hong Kong-listed Anta, which owns brands including Fila, has been working with an advisor to evaluate a bid for Puma. And over in the United States, it may be Thanksgiving, but the Federal Reserve Beige Book survey of regional business contacts says US economic activity was little changed in recent weeks, though overall consumer spending declined further, except among higher-end shoppers. Employment declined slightly and prices rose moderately. And Guy, I've seen so many references in the past 24 hours to K-shaped economies and K-shaped dynamics in the US.
Yeah, very split in terms of the way that the consumer behaviour story is playing out at the different economic quartiles, and you can certainly see that in the data. Let's talk a little bit about what we're seeing here in the UK. The United States is closed today. We have seen, obviously, some movement in the dollar of late, and that is a factor in the next chart that you are looking at here, which is the FTSE 100. As the pound gains a little bit of strength, you could argue that mechanically that should actually be a little bit negative for the FTSE 100. But the FTSE 100 is coming back a little bit today. Fairly stable session on light volume. What I want to show you, though, is that pound chart, and this is the two-day session that we are looking at here. You have seen the British pound rising through the budget, and then a little bit of a drop-off that we're seeing this morning. UK 10-year gilts, this is the picture here. Little reaction again yesterday. Most of it actually came towards the longer end of the curve. And the UK 10-year this morning, not a great deal changed. We're at kind of 440. I think it's the issuance story that largely kept the bond market calm yesterday, rather than maybe the economic outlook. The most sensitive part of the UK market when it comes to equities is, of course, the FTSE 250. We don't really look at the FTSE 100 when it comes to that story, but the FTSE 250, full of house price, full of the house builders, etc., and much more sensitive to the UK consumer. And as you can see, on a two-day basis, we are higher, Chrissy.
Absolutely fascinating to see how these markets are shaking out. Will we see a little bit more of a change when it comes to the volume picture? Let's come right back to our UK budget special, of course, and bring in our next guest. Martin Gilbert, chair of River Global and Revolut, joins us right here on this rooftop. Martin, thank you so much for your time, for bundling up with us. We certainly appreciate it. Your initial take on this budget, from the perspective of a founder, if I wanted to start a business, were you confident? Were you given confidence by this budget that as a founder, this is the place to start that journey?
Yeah, I think the Chancellor was caught between a rock and a hard place to a certain extent. Her left sort of leaning MPs and the bond market. So I think probably the balance is probably right. I think we've a step in the right direction as to founders, I would say. You know, the 3-year stamp duty holiday, the upping the limit in the ISA. I would have pressed the Treasury a bit harder on making British stocks come back into it. There are some technical details of how you would measure it within an ISA. So I think that'll be the next step, hopefully, going forward. To
very specifically allocate to British stocks.
Yeah, to British stocks.
Does the UK, though, have that structural, and I should say the scale of that operation? When you compare it to other markets around the world who are able to do that and able to mandate it, let's say in the S&P 500, for example, that's a game of scale. You have to have a massive amount to do that. Is there enough volume here?
Yeah, I think so. There's enough good companies here. They're being taken out at one a week at the moment in the 250. So we have a very undervalued market. And I'm old enough to remember when the ISA was first introduced as a PEP. It was UK stocks.
So 25 years ago?
Yeah. That shows how old I am and how long I've been doing this, sadly. But no, I think we're heading in the right direction as far as I was a bit disappointed that the VCT limit came down from 30 to 20% tax relief. So that was sort of heading in the wrong direction. But I understand the economics that the Chancellor is faced with.
Isn't there a little bit of room for pushback on ideas about mandating people get into UK stocks when maybe they have a preference for other things? Or is it just about providing tax incentives if they choose to do so?
I think if you're giving a tax incentive, you're perfectly entitled to mandate where that money goes. And it was originally that, and then it became international. And it's been to the detriment of the UK stock market as we've seen it become much more international. The ownership of stocks in the UK has halved by individuals. I mean, there are there are more crypto holders than stockholders now in the UK, which is not really what we want to see.
Yes, I mean, would that really move the dial, Martin, or would it be more appropriate to focus on creating more tech startups and getting them to list here rather than
the listing
it from the other direction?
Oh no, you're quite right. The listing here is a big issue. Now we're heading in the right direction with the stamp duty holiday for 3 years. So that has helped because the automatic place you go to list as a fintech is NASDAQ because it's deeper liquidity and they don't have the stamp duty. So at least one of the things has been taken away, that. But it's still a big problem getting companies to come here because this is traditionally, traditional markets, sort of dividends. As you said, housing stocks, mining stocks, traditional industries market, whereas NASDAQ is very much fintech.
Does growth equal stock market performance?
Yeah, I think so.
Where's the growth?
Yeah, it does. I mean, I think you can invest in the FTSE 250, and even if you don't get growth, you're going to get a company a week being taken out by private equity. So you don't even need growth in the FTSE 250. But I think, growth does equal stock market performance.
So this morning, not exactly a great day for the UK stock market. The growth story is getting worse, not better.
Yeah.
Why am I being encouraged to invest in the UK at the moment?
Because it's cheap. It's so cheap. I mean, it's.
Why is it cheap?
Because of the flood of money over the last 20 years out of equities into bonds. I mean, I'm bemused by the fact anyone wants their pension in bonds, but you can see why the finance directors of PLCs de-risk their balance sheet. So that's what's happened.
What kind of mood music does it create, Martin, when you look at taxes on dividends going up, savings income going up? I mean, the Labour Party says it's about making that tax take fairer versus other sources of income. Yeah,
I think I would have been more worried if capital gains tax had gone up, because you really want to be making capital gains, don't you, rather than extracting dividends out of companies, and that's part of the problem with the UK market, isn't it? We pressurize the companies to pay us dividends, whereas rather than reinvest in the business and grow the business.
We've had this kind of overhang over the UK economy, over UK financial markets, kind of post-Liz Truss. Are we in any world where that is dissipating, that there is a sense of trust back into this economy? Like, the bond market was becalmed because of this budget, but it largely knew what was going on. How fragile? You have seen confidence, you have seen fragility. Kind of where are we on the spectrum of that right now?
Well, as governments borrow more and more money, the bond markets become more important to them, which is why the budget was so slanted towards that particular audience. So I don't see the bond market's importance diminishing at all.
There's a question here of not just an exodus of investors, an exodus of money, but an exodus of British residents to other financial capitals in the world, famously Dubai.
Yeah.
Does this budget encourage more of that?
It hasn't stopped it, that's for sure. I don't think it encourages it. But I think the worrying thing is we're losing not the non-DOMs, we're losing a layer below the non-DOMs to the Middle East. And I suppose, 20 years ago, if someone had asked my advice where to go, I'd have said go to Asia. Now I would say go to the Middle East. I mean, that's where the growth is, that's where...
So what would stop the exodus? You said it hasn't encouraged it, but it hasn't stopped it. What would stop it?
Look, I mean, we've always been exporter of talent in this country. I mean, to Americas before and then Asia over the last sort of 20 years. I think what we want to do is get them back, encourage them to come back once they've made their money, you know, or got some money by that stage. We'll
try and find some sunshine. That might help as well, Martin. The hunt is on for the sun today.
It's nice in Dubai. I mean,
it is. I thought you were going to say here. I mean, it's fine. Martin, thank you very much. Thank you so much for joining us. Martin Gilbert, chair of Revolut and River Global, giving us the city's perspective, a founder's perspective as well, on everything we heard from the budget yesterday. Now, the UK Chancellor Rachel Reeves announced £26 billion of tax increases in a budget that was meant to convey stability, but left investors reeling when most of the key measures were accidentally released early by Britain's Office for Budget Responsibility. The OBR has issued an apology.
But let me start with an apology. A link to our economic and fiscal outlook document went live on our website too early this morning and was subsequently removed. We apologise to the Chancellor, members of Parliament for this technical error and have initiated an investigation into how this happened. It'll be reporting to our Oversight Board, the Treasury and the Commons Treasury Committee on how this happened and how to make sure it doesn't happen again.
There's the mea culpa. Well, Office Budget Responsibility Chair Richard Hughes speaking yesterday. Bloomberg's Lizzie Burden put it to Rachel Reeves that the OBR have said that none of the policy measures laid out in the budget have a significant impact on their forecast for UK growth. Let's listen to what Rachel Reeves had to say in response.
Well, in the spring, you'll remember that they scored £6.8 billion, the biggest ever non-fiscal scoring that the OBR have ever done for our planning reforms. Just a couple of days ago, the Planning and Infrastructure Bill was in the House of Lords. That is now almost complete, just one more return to the House of Commons, and then that bill will get royal assent. And the OBR haven't scored the India deal, the EU deal, or the US deal. And that's why I'm confident we can beat these forecasts on growth. We've beaten them this year with 1.5% growth now forecast, not the 1% they forecast in the spring. And I'm confident that we can beat those forecasts again.
So finally, Chancellor, you've effectively just broken your promise made after the last budget not to raise taxes again. Will you now rule out more tax rises, whether directly or by stealth, this Parliament?
So last year I had to close the black hole in the public finances left by the Conservatives. In the budget last year, I lived within the forecast set by the OBR. They have now changed their forecasts around productivity, and they are very clear that's nothing to do with the policy of this government, but that does mean they forecast lower tax revenue coming in. And I was always clear that I would never play fast and loose with the public finances, because it's ordinary working people and businesses that pay the price when that happens. So these are the fair and necessary choices in the circumstances that I faced. But what I'm now determined to do more than ever is to grow our economy so that we have the revenue both to keep taxes down and also to fund our public services. And that is what this government's plan for growth is all about. Whether it's pensions reform, planning reform, the changes today to help make Britain the best place to start up, to scale up and to stay, with the changes to stamp duty for shares for companies newly listing in the UK, I'm determined that we get the growth that our economy has been sorely lacking for too long, and we do that through the reforms that we've set out.
Well, no confirmation of no new tax rises,
well,
Chancellor.
No Chancellor can write future budgets. I took the fair and necessary choices today, but my focus has been and always will be on growing our economy so that we can keep taxes down and have the money we need to invest in our public services.
UK Chancellor of the Exchequer Rachel Reeves, I think that last line is really crucial there. She's saying we want to encourage growth. We also need the money to invest in our public services. Yep. Did she check any of those boxes in yesterday's budget?
Well, we're hunting for the growth story, aren't we? Maybe we found it. There's plenty of noise, construction noise going on around us. We apologise if anyone can hear it.
I think it's deconstruction noise.
Deconstruction noise. I think that has a value.
I think so. Recycling. Let's call it recycling.
Good start.
Yes.
Good start.
This is the challenge, though. The UK economy has no growth. If you want to have decent public services, you have to have a vibrant economy to back that up.
Yeah.
You could do it in the short term, but you can't do it in the long term. And that, I think, is the challenge that the UK now faces.
Well, let's see how this all pans out. She has 5 years to deliver on some of these promises, a little less. Politically speaking, lots to digest there. We're going to put some of these questions to our next guest on the program. Of course, as the UK asks the wealthy to pay more tax to fund welfare and growth in the budget. You just heard it from Rachel Reeves. We just discussed the viability of it. Let's get the views of entrepreneur and charity donor John Caudwell joining the program next. This is Bloomberg.
Welcome back, everybody. This is the opening trade. It's been an eventful post-budget day special from here on the balcony. Here are some of the highlights so far from our guests.
There's no sort of catastrophic downgrade to growth, but equally there's not much in this budget either in terms of tax reform or policies more widely that will be good for growth.
I think the government has struggled somewhat with the narrative around growth. So what they've chosen to do is take a path of talking about stability. We're going to keep corporation tax capped at 25%. We're going to keep the 100% capital allowances. We're going to give certainty in the UK system. And so that's the path they've chosen, rather than necessarily a big fanfare about attracting investment.
The market did well yesterday. And I think that's because there were basically, 3 channels she had to get right for us. One of them was about issuance, one of them was about fiscal credibility, and one of them was about the sort of trajectory for inflation. The problem that the UK has had is it does have sort of European levels of growth, but it has kind of US levels of inflation, right? And it's the inflation premium that keeps yields high, I think, more than anything else in the UK.
While growth has been the real dominant factor in equities in the last decade, led by technology, this year we've had quite a big mix of growth doing well, but also value stocks being re-rated. And the UK is a really dominant value market, has a high yield, very high free cash flow yield, very low multiple. The banks, for example, will benefit, I think, from these reforms.
I think the Chancellor was caught between a rock and a hard place to a certain extent. Her left sort of leaning MPs and the bond market. So I think probably the balance is probably right. I think we've a step in the right direction as to founders, I would say. The 3-year stamp duty holiday, the upping the limit in the ISA. I would have pressed the Treasury a bit harder on making British stocks come back into it. There are some technical details of how you would measure it within an ISA. So I think that'll be the next step, hopefully, going forward.
The views from entrepreneurs and philanthropic giants in the UK around what we heard from the budget statement yesterday from none other than Chancellor Rachel Reeves. Does it go far enough? Let's ask John Caudwell, who of course is an entrepreneur in his own right and a philanthropist as well, joining us right here on the balcony for our UK budget special. Thank you so much for your time and for joining us. Good morning. We heard there from a series of guests talking about this. The buzzword seems to be growth. Was this budget a step in the right direction? Did it go far enough?
There's a lot wrong in the budget, but let me be balanced about this, and I think it was the best budget that we could expect under the circumstances. If there was damage done, which there was, it was done in the last budget, and we are not pushing Britain's GDP growth anywhere near in the direction we need to do. So there's real problems within the budget, and I think moving money into the welfare, this is a difficult one, because if you've got a family that are on these credits for children, and they've got more children and they genuinely can't work, or we need to look after those kids and keep them out of poverty. But by the same token, there's potentially a real trap here where we finance people to stay at home, give them all these universal credits, and they're not really motivated to go to work. Now, the devil's in this detail. I don't know if they're going to find a way of driving people into work. But we've got 1 million young people between 20 and 30 out of work. That has to be solved. But we have to create jobs for them and motivation for the future, and that's where the inward investment comes in.
Isn't the best way to do it growth? This is what we're lacking here at the moment. Yes, the budget ticked all the boxes yesterday. Yes, it was maybe the budget that we all should have expected. But it wasn't a budget that is going to significantly change the economic trajectory of this country.
No, absolutely not.
How do we do that? You've run a business. Tell me.
It's relatively simple. First of all, we are where we are financially, so that gives us a difficult headwind. But we go out, we send 20 titans of industry all around the world, meeting businesses that might come to the UK, which have been previously not found by...
I thought businesses were leaving the UK at the moment. I thought people were leaving the UK, not coming in.
Yes, but that's not businesses. That's not businesses leaving the UK. It's rich people. But to my point earlier, if rich people leave the UK, will rich people who want to bring a business to the UK come? We need to make everything business friendly, and the last budget was not business friendly or rich friendly. But we are where we are now. What we do now is we send 20 titans of industry out into businesses to research what do we need to do to get you to move your business into the UK. And corporation tax would definitely be one of those, but also a concierge service to make it easy to move to the UK to reduce restrictions and bureaucracy. And if we do all of that and drive these people in really proactively, go and find them and negotiate with them to come in. And we create high-paid jobs because they're all in the high technology spaces and environment, medicine, you know, all those areas where there's a lot of money to be made. We can then pay higher salaries to people, and if those businesses achieve the number of employees that they forecast and the higher salaries, then they get a reduced corporation tax. That costs the government nothing because we haven't got those businesses. And what we do is produce GDP growth for Britain. It's a simple formula. It's, you know, it's a hard task to do. That's why I use the expression titans of industry. People would volunteer to go and do this job.
So that's advice, perhaps, if she's shaping the next budget. We'll see whether she's listening and whether we get any
Well, do you know, that's not even a budget issue, though. I've been telling them they should do this for years.
Well, yes, and they could be doing it between budgets.
Any time. It's nothing to do with budget.
Now, you've been talking about growth, John. You've been outspoken on green growth in the past and the need to get more green growth in the UK. What do you make of that agenda in the UK right now, in particular the EV road pricing model?
I think it's all a bit of a muddle, to be honest, and it's all sending mixed messages, because what people will take away is that they've got to pay 3 pence a mile, I think it's from 2028, on their electric vehicle. Now, if you're going to go to a 3 pence a mile or per cost per mile, why not scrap road excise licence altogether and have every vehicle owner paying a pay-per-use on the mileage?
Maybe this is the start of that.
Well, maybe it is, but why not just do it? Be radical. What we need is radicalism that changes the UK for the better and that simplifies things and makes it a clear, simple formula. So the cost per mile on EVs could be a much lower level than the cost per mile on diesel engines and petrol engines, to drive the right behaviour and to just have one simple formula.
You're staying, right? You're not going anywhere.
I'm staying. I'm not going to stay here for very long because it's a bit cold.
You're dressed for the London weather.
And on that note, what a perfect point. We will conclude the conversation. Lovely to see you, John. Thanks for stopping by.
Okay, pleasure, thank you.
Here, British entrepreneur, John Caudwell. That wraps things up. We have spent the morning out here digesting, discussing the budget. Have we reached any conclusions?
Well, I think growth came out from that, those clips.
Yes.
You know, people reflecting on, well, OK, that was all very well, but where's the growth? That was the big message.
There's growth, there's more taxation. If we don't get growth, then at least maybe the fiscal finances will get solved. There is maybe a silver lining.
OK, happy Thanksgiving Day.
Thank you. Thank you.
I want to find pumpkin pie.
Yes, we're going to go do some turkey eating after this. That does it for the opening trade. The Pulse is up next. Thank you for joining us today. This is Bloomberg.